Happy Monday, everybody. I hope you had a great weekend. Today is October 3rd, 2022, and this is your first of Q4 Monday Market Update. Let's start off by saying that we are glad that September's over. We don't know what October's going to bring, but regardless, September's over. What a month it's been. By the close last Friday, all of the major averages were down. For the month of September alone, the stats are pretty ugly or pretty exciting, depending if you are a buyer, a shopper, or a holder. Overall, the Dow was down 8.8%, the S&P 500 was down 9.3%, and the NASDAQ was down 10.5%. And that was for the month. The Dow printed the worst September since 2002. And though I don't want to ruin my special perspective video that's coming up, but this was the tail end of the dot-com bubble bursting. The largest inflow into bond funds until that time occurred in September of 2002, and that was pretty close to the end of that market sell-off. Okay, if you're still watching, there is good news. So first of all, as I mentioned last week, it has happened many times in the past. As September's a bad month, October comes in and has been called a bear killer, in that it is where the bear markets go to die. I mentioned on the Friday's video that I'm working on another special video. This one will be to give some perspective on why the market is acting the way it is, what historical precedents we have for this, and even some information on the upcoming earnings season and the midterm elections. For now, let's do a quick recap of last week's market action and a preview of what we can expect this week. Just to recap from the Wednesday update, Monday stocks opened slightly lower, reacting to the British pound and the reaction across the pond to the fiscal stimulus announcement and the inflationary read on that. Exactly what we all know we do not need is the inflationary side. Stocks did make half-hearted run at Friday's highs early, but failed to have any staying power. More news from the Bank of England, and the pressure on risk assets was too much. The S&P 500 broke June's lows and was down a bit over 1%, Dow down 1.11%, and the NASDAQ down 0.6%. Tuesday's stocks look like they may provide a rare feat, a positive day. At the open, following one of the Fed heads' comments about worry about going too far too fast, we'll see how that goes. The Dow opened and was up over 1%, S&P up over 1.5%, the NASDAQ up over 2%, but as you can imagine, that was short-lived. By noon, all three indices had turned negative, as two of the three closed negative. Dow was down 0.43%, S&P down 0.21%, and the NASDAQ slightly positive, up about 0.25% to break a losing streak. Wednesday was a standout day, something that took many by surprise, a positive day, and big time. Stocks opened near unchanged, digesting the new bond buying program that Bank of England announced. I'll get back to that in a moment, but the external forces took over. By the lunch hour, the British pound turned positive, yields headed lower, stocks, well, they tried something new, green arrows. By the end of the day, the 30-year gilt yield, that's the UK government version of our treasury bonds, the latest in the new items that we're learning to watch, well, the gilt yield dropped more than 1 full percentage point in the last hour of trading. The British pound bounced by 1.3%. This had the S&P and all of the markets run up, a bit of profit taking at the close, but they all closed near the highs for the day. By now, it will not surprise you when I tell you that all three indices closed up just about 2% for the day. Remember, algos, computers tend to watch the index next door. So everyone who was on the buying side of the boat on Wednesday ran, of course, you guessed it, to the other side, the selling side on Thursday. And sell they did. Almost the mirror image of Wednesday's news from the UK, US eco data, jobs data, and even the Fed heads got in on the action to move everyone back to the other side. By the end of the day, the Dow was down 1.5%, S&P was down 2.11%, the NASDAQ was down 2.84%. Overall, not so unexpected. Wednesday was a rally that really never should have happened, so it had to be retracted. Friday was looking at some headwinds straight in the face and spent most of the day fighting those off. Nike and Micron both talked about inventory being bloated. Now, more for that in perspective video that'll come soon, but you can see this is like what we have, things we've never seen. And while I agree that a comparison to the Spanish flu time is not a good idea, we've had events in the past 50 to 100 years that bring us enough data to properly evaluate these markets. By the end of the day, all major stock market indices were in the red. Dow was down 1.71%, S&P down 1.5%, and the NASDAQ was also down 1.5%. Another down Friday. I think that may be 4 or 5 in a row. As I suggested, as we started September, this is historically a rough time, September and October. So while we're happy to see September go, October may be no prize. We'll have to wait and see. I've mentioned before, this is the time that we see many earnings revisions. I've reported that the price target cuts are still coming fast and furious, but the estimates as we approach the earnings season should be coming down. That's a headwind for sure, but this is already priced into the market, in my opinion. We'll have to see what that is like. For now, let's look to this coming week. You'll find Yom Kippur in the middle of the week, and although there's a good chance for some pour-over fireworks as the week goes on, the trading volume is some of the lowest reported during that day for the year, and that is that day and then the Friday of Thanksgiving week are the slowest trading days of the year. Quick rundown of the major events to watch for this week. Today we'll bring PMI and some construction spending numbers. PMI will be important because as long as we see that it stays over 50, it's still showing expansion. Tuesday we'll bring the JOLTS report. Remember that is the report on the job openings, still running at about 2 times the amount of people looking for jobs. Many say that it is an inflated number, but remember, even if it is inflated, it's still showing a tight labor market, as if anyone who has tried to get some kind of services doesn't see that everyone seems to be understaffed. As this is the first week of the month, it's jobs week, so in addition to JOLTS, we'll get ADP reports on Wednesday, jobless claims on Thursday, and the very important non-farm payrolls on Friday. I'm not sure that it will move markets as much by the time we get to Friday, but as of now, it is the big data point to watch, so stay tuned. Overall, this is only the U.S. eco data that I'm talking about. Recall that the real mover in last week's market was not all the Fed heads, it was the Bank of England and what's going on there and around the world also. So we have a lot to watch, a lot to go wrong, and as you can imagine, a lot to go right. This continues to be a time that we are kept on our toes by all that's going on and how the market reacts to it. Earnings season is coming before we know it. We'll see if that growth that we were counting on comes through. It remains to be seen. As I told you before, to quote the LPL chief equity strategist Quincy Crosby, October has been a bear killer in the past. Will it come through again? Please remember these videos are for the mass information dump. Please stay in touch as we can discuss if this will require action on your plan. Keep watching and check out the Friday videos with some planning ideas as we enter Q4. Have a great week.